Hello everyone, I'm Ethan Cole, and welcome back to the channel. Today, I'm going to tell you the incredible story of Warren Buffett, a man who started making money as a child, bought his first stock before most kids even had a bank account, and eventually became one of the richest investors in history. This isn't a story about luck, it's a story about patience, discipline, and the power of making smart decisions for decades. Imagine knowing what you wanted to do for the rest of your life before turning 10 years old. Most children dream about becoming athletes, actors, astronauts. Warren Buffett dreamed about making money, not because he loved luxury, but because he loved the game, the challenge, the numbers, and the idea of turning $1 into $2. Warren Buffett was born on August 30th, 1930. America was suffering through the Great Depression. Businesses were collapsing, banks were failing, millions of families struggled every day. Yet inside this difficult environment, Buffett developed a fascination with money. Unlike most children, Warren constantly asked questions. How does a business make money? Why do some stores succeed? Why do others fail? Where does profit come from? These questions would eventually shape his entire life. At 6 years old, Warren started his first business. He bought packs of chewing gum, then sold individual pieces door to door. The profit was small, but the lesson was powerful. Buy low, sell higher, keep the difference. Soon he expanded. Warren bought 6 packs of Coca-Cola, then sold individual bottles for profit. Most children spent money. Warren focused on earning it. Every dollar became an opportunity. As Buffett grew older, he became obsessed with finding new opportunities. Everywhere he looked, he saw businesses. Every problem looked like a potential investment. Every dollar had a purpose. Numbers fascinated him. He memorized statistics, calculated profits for fun, and spent hours reading financial information. Most kids avoided math. Warren couldn't get enough of it. At 11 years old, Buffett bought his first stock, 3 shares of City Service Preferred. The price immediately dropped. He felt nervous. The stock later recovered. Warren sold for a small profit, then watched the stock rise much higher. The lesson hurt. Patience matters. Years later, Buffett would say this experience taught him one of the most important investing lessons of his life. Great investments need time. Many people quit too early. Many people sell too soon. Patience often separates success from failure. As a teenager, Buffett delivered newspapers every morning, before school, before most people were awake. He worked consistently, not because he had to, because he wanted capital to invest. Most teenagers spent their earnings. Warren saved them. Every dollar earned today could become many dollars tomorrow. This simple principle became one of the foundations of his future fortune. By age 14, Buffett had saved enough money to purchase farmland. Think about that. Most teenagers dream of buying a bicycle. Warren bought productive assets that generated income, even while he slept. Buffett wasn't focused on looking rich, he was focused on becoming rich, and those are very different goals. One spends money, the other invests it. Eventually, Buffett attended college, but he believed practical experience mattered just as much as formal education. He continued studying businesses, financial statements, and investment opportunities. Then Buffett discovered a book, The Intelligent Investor, written by Benjamin Graham. The book introduced a revolutionary idea. Stocks were not lottery tickets. They were pieces of real businesses. Buffett became fascinated by Graham's ideas, so fascinated that he wanted to learn directly from him. There was only one problem: getting accepted wouldn't be easy. Instead, Buffett enrolled at Columbia University, where Benjamin Graham taught. What looked like a setback became one of the greatest opportunities of his life. Instead, Buffett enrolled at Columbia University, where Benjamin Graham taught. What looked like a setback became one of the greatest opportunities of his life. Graham taught a simple principle: buy great assets for less than their worth. Ignore emotions. Ignore hype. Focus on value. These ideas would become Buffett's foundation. Buffett wasn't just another student. He was obsessed. He studied every lesson, every example, every investment principle. And Benjamin Graham noticed. After graduation, Buffett hoped to work for Graham. Initially, he was turned down, but eventually, persistence paid off, and he received the opportunity he had dreamed about. Working under Benjamin Graham gave Buffett something more valuable than money: experience. He learned how to evaluate businesses, assess risk, and think independently. By the mid-1950s, Buffett was no longer simply interested in making money. He understood how wealth was created, how businesses worked, and how investments could compound over time. The student was becoming a master, and soon Warren Buffett would leave his mentor behind to start building an investment empire of his own. The boy who sold chewing gum had learned the principles of investing. Now he would put those principles to the test, and the results would change financial history forever. In 1956, Warren Buffett returned to Omaha. He was just 25 years old. Most people his age were looking for stable careers. Buffett had a different plan. He started an investment partnership with money from family and friends. The amount was small, but Buffett wasn't worried about size. He was focused on performance. Year after year, Buffett outperformed the stock market. While others chased trends, Buffett searched for bargains. He looked for companies selling below their true value. The strategy worked. Investors noticed. Money started flowing into the partnership. One day, Buffett found a struggling textile company. Its name was Berkshire Hathaway. The business itself wasn't exciting. The mills were aging. Profits were shrinking. But the stock looked cheap. Buffett began buying shares. After a disagreement with management, Buffett made a surprising decision. Instead of selling his shares, he bought more. Eventually, he gained control of the company. What started as a small investment became the foundation of a future empire. Then Buffett discovered something powerful. Insurance companies collect premiums today, but often pay claims years later. That money sitting in between is called float. Buffett realized float could be invested, and if managed correctly, it could become a massive source of capital. Most businesses need capital. Buffett's insurance companies generated it, year after year. The float became Berkshire Hathaway's financial engine, and one of the greatest advantages in business history. Buffett's thinking evolved. Instead of buying mediocre businesses at cheap prices, he began buying great businesses at fair prices. This change transformed his investment strategy forever. When American Express faced a major scandal, investors panicked. Many sold. Buffett did the opposite. He studied the company carefully, then invested heavily. The investment became one of his biggest successes. Soon Buffett spotted another opportunity, the Washington Post. The company was worth far more than the market believed. Buffett invested. And once again, patience paid off. Then came one of the most famous investments in history, Coca-Cola. Buffett loved simple businesses, strong brands, loyal customers, and global reach. Coca-Cola had all three. He was investing in human behavior, and that made all the difference. As Berkshire's investments grew, so did Buffett's fortune. Millions became hundreds of millions. Hundreds of millions became billions. The investor from Omaha was becoming a legend. Then came the financial crisis. Markets collapsed. Fear spread everywhere. Investors panicked, but Buffett remained calm. Buffett followed a famous rule. Be fearful when others are greedy, and greedy when others are fearful. While others sold, Buffett invested billions. One of Buffett's most famous crisis investments was Goldman Sachs. The deal generated enormous returns. Once again, Buffett turned fear into opportunity. Years later, Buffett surprised investors. He invested heavily in Apple. Many thought technology was outside his comfort zone, but Buffett saw something different. He saw one of the strongest brands in the world. The Apple investment became one of the most profitable decisions in Berkshire Hathaway's history. It added hundreds of billions in value and proved Buffett could still adapt. People often ask Buffett's secret. The answer isn't complicated. Time, patience, compounding. Small gains repeated over decades create extraordinary results. Buffett spends much of his day reading annual reports, books, newspapers. Knowledge compounds just like money, and Buffett never stopped learning. Despite becoming one of the richest people in history, Buffett made another remarkable decision. He pledged to give away most of his fortune, believing that wealth should benefit society. Today, Warren Buffett is known as the Oracle of Omaha, not because he predicts the future, but because he understands timeless principles, patience, discipline, and rational thinking. Warren Buffett's story teaches us that success doesn't require genius. It requires consistency. Most people overestimate what they can achieve in a year and underestimate what they can achieve in decades. Warren Buffett didn't build his fortune through luck. He built it through patience, discipline, and thousands of smart decisions repeated over a lifetime. And that's the lesson. Great success is often the result of small actions repeated consistently for years. If you enjoyed this story, subscribe for more documentaries about the entrepreneurs, investors, and companies that changed the world. Until next time, keep learning, keep building, and keep thinking bigger.